Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
There is no problem so complicated that you can't add more bureaucracy to it. A corporate reorg is like shuffling deck chairs on the Titanic. The only thing we learn from history is that we learn nothing from history. Education is what you get when you read the fine print. Experience is what you get when you don't. If it sounds too good to be true, it probably has a hidden subscription fee.
After years of looking expensive, enough to need justification, the Nifty is finally just mildly overpriced. Forward price to earnings is at 17.3x, below the 10-year average of 18.6x. Progress but no bargain sale yet. What changed? Earnings held up but the multiples quietly deflated. Classic case of markets sobering up without a full-blown hangover. Historically, India still trades at a premium and continues to earn it with stronger growth and consistent outperformance versus MSCI Emerging Markets Index. 3 decades of data and FY26 might just take the crown for all the wrong reasons. FPIs did not just trim exposure, they exited with conviction. And here's the kicker. 4 of the 5 worst years for foreign flows have happened after 2021. That's not a blip, that's a regime shift. So why? Higher global yields slowing earnings momentum and India's premium valuation finally meeting resistance. When US bonds start paying, emerging market romance tends to fade quickly. Tariffs did not kill trade. They just gave it a new passport. China's share of US imports is down, but the deficit, still alive and well, just redistributed. Supply chains are playing musical chairs. Vietnam picks up electronics, India grabs smartphones. Made in China quietly becomes assembled elsewhere with Chinese parts. And here's the punchline. For critical inputs like rare earths, the US still leans heavily on China. So much for strategic decoupling. Maharashtra crosses 2 crore investors and suddenly equity culture is an urban elite, it's nationwide retail muscle. UP and Gujarat are not far behind and the map tells a bigger story. Markets are no longer a Bombay club, they are a mass movement. SIPs, apps and lockdown era curiosity have quietly turned millions into investors. But here's a twist. More participants doesn't always mean smarter markets. Retail flows can amplify both rallies and panic. Bottom line, India's market depth is rising, now stability has to catch up. Forget goods. India's biggest export to the Gulf is human capital. Millions spread across the UAE, Saudi and Kuwait, powering economies there and sending billions back home. This is not just migration, it's a financial pipeline. Remittances cushion India's current account, while Gulf growth quietly depends on Indian labor across sectors, from construction to consulting. But here's the risk, geopolitics. Any disruption in the region isn't just an oil story, it's jobs, incomes, and remittance flows at stake. Banks are lending like it's festival season. Industry, services, agriculture, even personal loans, all growing in double digits. This is not a one-sector story, it's a broad-based credit expansion. Industry is finally waking up, services are steady, and personal loans, after a brief scare, are back in the game. Translation, demand is alive, and banks are willing to fund it. But here's the catch. When everything grows together, risks quietly build together too, especially in retail credit. Bottom line, the credit engine is humming. Now let's see if asset quality keeps up.